In the winter chill of the 17th century, as the Dutch Republic stood at the height of its power, a strange plant with delicate petals and vivid stripes began to command prices so high that a single bulb was worth more than a canal-side mansion. Merchants traded them like gold. Citizens boasted about them like trophies, and the entire economy, one of the most sophisticated in the world, flirted with disaster because of them. But here is the mystery that challenges everything we think we know about financial madness. How did a flower, with no practical use, become the item people feared missing out on more than anything else? And why did some of the most educated, rational people in Europe ignore every warning sign until it was too late? The answers lie in a story full of illusions, incentives, and human psychology, where speculation didn't just take over markets, it took over the minds of an entire society. To understand the world in which tulip mania erupted, we have to step back into a time when the Dutch Republic was becoming the financial capital of the world. Amsterdam's merchants had mastered global trade routes stretching from the Baltics to the Indian Ocean. The Dutch East India Company was the largest corporation ever seen, and its shares were being traded on what amounted to the world's first modern stock exchange. A new middle class was rising, one with disposable income, a hunger for status symbols, and a taste for novelty. Wealth was no longer confined to the aristocracy. Shopkeepers, artisans, shipbuilders, and traders could suddenly accumulate fortunes. This shift created both opportunity and instability. People wanted to display their success, and nothing conveyed sophistication quite like rare flowers imported from the distant lands of the Ottoman Empire. Tulips were not just plants. They were exotic, fragile, and difficult to cultivate. Their colors varied wildly, especially the striped, broken varieties produced by a mosaic virus that no one understood at the time. This unpredictability made certain bulbs exceptionally rare, and rarity, in a booming economy, creates fascination. Collectors began cataloging tulip varieties, giving them elegant names: Viceroy, Semper Augustus, Admiral van der Eickhout. These weren't just flowers, they were luxury assets. And luxury assets tend to attract speculation long before everyday people notice anything strange happening. In the quiet outskirts of Dutch towns, early tulip enthusiasts began trading bulbs privately, often among wealthy gardeners and botanists. At first, prices were high but not irrational. A rare bulb might cost several months' wages, which was extravagant but not unimaginable. Yet something subtle began to shift. The conversations moved from botany to profit projections. People started estimating what a bulb might be worth next season, or the season after that. And because tulips took a long time to mature and flower, the market naturally drifted toward forward contracts agreements to buy bulbs that didn't even exist yet. This was the spark that would eventually ignite everything. As more money entered the trade, tulips became a way to signal intelligence, taste, and economic savvy. Suddenly, possessing a rare bulb wasn't just about beauty. It was a statement. Asterisk. I understand this new economy. I know how to spot opportunity before others do. Asterisk. And this desire to appear ahead of the curve drove the prices higher. A bulb bought for modest sums one year could be sold for multiple times that amount the next. Whispers spread through taverns. Apprentices, artisans, and even farmers began to hear stories of people who made life-changing amounts of money overnight. The fear of missing out took hold. Then came a crucial turning point. As enthusiasm grew, guilds and taverns began hosting informal trading sessions where tulip futures could be bought and sold rapidly. These markets became highly liquid. Bulbs changed hands multiple times in a single day without ever leaving the ground. Buyers placed tiny deposits relative to the full price, magnifying both potential gains and potential losses. The entire system depended on confidence, on the assumption that someone else, at some future point, would pay more. And as long as prices kept rising, confidence was bulletproof. But the rise wasn't fueled by tulips themselves. It was fueled by the stories people told each other. Stories of neighbors doubling their money. Stories of merchants retiring early. Stories of rare bulbs whose prices would never fall because wealthy collectors would always want them. The Dutch Republic had created the perfect incubator for speculative fever, a prosperous society comfortable with financial innovation, a rising middle class hungry for upward mobility, and a new asset class that felt both sophisticated and accessible. By the height of tulip mania, some bulbs were selling for values so extreme they defied comprehension. A single Semper Augustus bulb reportedly cost more than a grand home on Amsterdam's most prestigious canal. Another variety could be traded for carts, livestock, wine, and furnishings, an entire lifestyle bundled into a single flower. People began mortgaging property, pledging future earnings, and using whatever they could as collateral to participate in the tulip trade. And here is where the mystery deepens. Did the Dutch really believe tulips were worth this much? Or were they simply trapped in a game they didn't know how to exit? The truth is more complicated than the myth. Many participants were aware the prices were unsustainable, but they weren't buying tulips, they were buying time. As long as someone else was willing to pay more next week, they were safe. The mania persisted not because people were irrational, but because everyone believed they could get out before the crash. Then came the breaking point. In early February of a particularly cold year, a routine auction in Haarlem failed to attract bidders. It wasn't a dramatic crash, just a quiet moment when buyers hesitated. But hesitation is fatal to a bubble built entirely on confidence. Within hours, word spread. The market is turning. People rushed to sell their contracts. Prices began to fall, slowly at first, then rapidly, as fear replaced optimism. Tulip bulbs that were traded for fortunes one week were suddenly worth a fraction of those prices. And because many of these contracts were based on deposits, the unwinding was chaotic. Buyers refused to honor agreements. Sellers demanded payment. Tavern courts were overwhelmed with disputes. The collapse wasn't just financial, it was psychological. People who once bragged about their bulbs now refused to admit they had ever traded them. Speculation became a source of shame. And because so much of the mania had been built on social status, the stigma spread quickly. The very thing that had propelled prices upward, the desire to seem clever now, pushed people to deny involvement entirely. In the aftermath, the Dutch government attempted to intervene. Proposals circulated to convert tulip futures into voluntary settlement contracts, where buyers could walk away by paying modest fines. Some argued for strict enforcement. Others believed forgiving the contracts was necessary to restore social order. But every solution came too late. The market had already collapsed, and no policy could convince people to revalue tulips at levels they now viewed as absurd. Yet the fallout, though significant, did not destroy the Dutch economy, at least not in the way later storytellers claimed. Trade continued. Amsterdam remained a financial powerhouse. The damage was more localized, affecting speculators, artisans, and small merchants, rather than the entire nation. But the psychological mark it left behind was enormous. Tulip mania became a metaphor, a cautionary tale, used for centuries to warn about the dangers of speculation and the fragility of mass confidence. And here's the uncomfortable twist. Despite being 4 centuries old, the pattern revealed by tulip mania keeps repeating. In fact, the world today resembles the Dutch Republic more than we'd like to admit. Rising middle classes across the world seek fast wealth. Financial markets operate at unprecedented speeds. New asset classes, from internet stocks to cryptocurrencies to meme stocks, capture public imagination. And each time, the same psychological ingredients appear: rarity, novelty, social status, leverage, and a belief that prices can only go up. Consider this. During a recent boom in digital tokens, the value of certain assets rose not by 10%, not by 50%, but by thousands of percent in a matter of months. Investors weren't buying utility, they were buying expectation. Trading volume surged on platforms open to anyone with a smartphone. Forums buzzed with stories of people turning small savings into life-changing wealth. And just like 17th century tulip traders, many participants didn't believe these prices reflected true value. They simply believed they could sell before the crash. Or look at the housing markets where bidding wars pushed prices so high that buyers offered above asking price without even seeing the property. Scarcity turned into excitement. Excitement turned into competition. Competition turned into fear of missing out. And suddenly, people across the world repeated exactly what the Dutch did centuries ago. They stretched finances, used leverage, and convinced themselves that this time would be different. Even the stock market shows echoes. When a company with no profits, sometimes no revenue, reaches multi-billion-dollar valuations based only on hopes of future performance, we see the same logic that once inflated tulip prices. The cycle is always the same. A new asset appears, early adopters profit, the story spreads, speculators rush in, leverage amplifies gains, confidence becomes collective. And then, often triggered by something as small as hesitation, confidence evaporates. Tulip mania is not an ancient anomaly. It is a mirror reflecting a timeless truth. Humans are capable of extraordinary irrationality when they believe others will act irrationally too. The Dutch did not lose control because of flowers. They lost control because they trusted the crowd more than their own judgment. So, what can we actually learn from the first great bubble in financial history? There are 3 key takeaways that remain painfully relevant. First, speculation becomes dangerous the moment people stop asking what something is worth and start asking only what someone else will pay. When value is measured by expectation rather than utility, the stage is set for instability. Second, leverage, whether in tulip, futures, margin accounts, or modern derivatives, magnifies everything. It accelerates gains in good times and multiplies losses in bad times, turning ordinary market swings into crises. Third, and perhaps most important, bubbles do not burst because people run out of money. They burst because people run out of confidence, and confidence is the most fragile asset of all. As we watch financial markets today volatile, interconnected, and driven by narratives, it's worth asking, which of our modern obsessions will future historians point to as the tulip mania of our time? Will it be digital currencies, artificial intelligence stocks, luxury real estate, or something entirely new that hasn't yet captured our imagination? The lesson from the 17th century is simple but unsettling. Every generation believes it is smarter than the last, and every generation eventually proves itself wrong. If history shows us anything, it's that the next bubble will not look like tulips. It will look like something we currently admire, trust, and desire, something that feels safe until the moment it doesn't. If you want to keep exploring the hidden forces that shape financial history, from ancient manias to modern market shocks, make sure you like this video, subscribe to the channel, and turn on notifications so you don't miss the next deep dive. The stories may change, but the patterns never do.